Have you heard the news? Someone just hit the massive $669.8 million Powerball jackpot. I saw that and thought, wow, what would it be like to win almost $700 million? I'd probably faint if I ever won that much money. But then I started thinking, that lucky winner isn't going to actually walk away with the full $669.8 million. Why not? Taxes. That's right. The lottery winner of the $669.8 million jackpot will owe significant taxes that will greatly reduce the amount of their windfall they actually take home. I will break down how much they can expect to pay in federal and state income taxes, based on the top tax brackets for high earners and various state tax rates. I will also discuss strategies they could potentially employ with financial advisors to reduce their tax liability, such as taking an annuity payment option or setting up a trust. It's important to note I don't have professional credentials in finance or tax law. However, as someone fascinated by money issues, I wanted to analyze the tax impact on such enormous lottery winnings. Actual winners should consult licensed tax and financial professionals to ensure they handle their windfall appropriately. My goal is simply to provide a generalized estimate for entertainment purposes of what a winner might owe and how they might lower their bill. The IRS treats lottery winnings like ordinary income, so they are taxed at the regular federal income tax rates. The current top tax bracket is 37% for any earnings above $539,900 for a single filer. So for our $669.8 million jackpot, the first $539,900 would be taxed at the lower rates in the tax brackets below that threshold. This includes 10% for earnings up to $9,950, 12% for earnings from $9,951 to $40,525, 22% for earnings from $40,526 to $86,375, and 24% for earnings from $86,376 to $164,925. But the vast majority of the winnings, the remaining $669,260,100, would be taxed at the top 37% rate. When we calculate 37% of $669,260,100, that comes out to around $247 million owed, just in federal income taxes on the jackpot. So you can see how the progressive tax system works here. Only the amount of winnings above each bracket threshold gets taxed at that bracket's rate. But for such an enormous lottery prize, most of the winnings are above the top threshold, and therefore get hit with the highest 37% federal tax rate. But wait, there's more. You also have to pay state income taxes on lottery winnings. Rates vary across the country from 0 in states with no income tax, up to over 11% in some states. If our lucky winner is from a high-tax state like California, their state tax bill could be another $73 million. So federal and state taxes could eat up around $320 million of the jackpot. That's insane. So after all those taxes are paid, the winner is left with $349 million before we factor in things like investment taxes and estate taxes when the winner passes away. Man, it's really starting to look like winning the lottery isn't quite as glamorous as it seems. But is there anything our winner can do to reduce how much of their jackpot goes to taxes? Let's look at a few options. One thing they could do is take the winnings as an annuity instead of a lump sum payout. With the annuity option, you get your full jackpot amount spread out in yearly payments over 30 years. Since your income is lower each year, you avoid getting bumped into the top 37% tax bracket. Your overall tax bill ends up being a bit lower in the long run. Setting up a trust to receive the lottery payout is a strategy that could help lower the winner's tax burden each year. There are different types of trusts with varying tax treatments and rules, but in general, a trust allows you to distribute assets and income in a tax-efficient way. The trust itself pays taxes on earnings and distributions at a lower rate than the top 37% individual rate. A properly structured irrevocable trust could potentially save millions in taxes on a high lottery payout. However, trusts also come with costs to establish and maintain, so winners need to evaluate if the tax savings are worth it. An estate planning attorney can help set up a trust in compliance with all IRS requirements. Donating a portion of lottery winnings to charity is another option winners could use to potentially reduce their taxes. For example, if the winner donated $10 million of a $100 million jackpot to a qualified charity, their taxable income would be lowered by $10 million. Depending on other factors, they may also be able to deduct that charitable contribution, further reducing their taxable income and tax bill. The winner would, of course, be giving up some of their prize money, but they'd fulfill charitable goals and lower their taxes owed. As long as donations go to legitimate charities, this can be an effective strategy to shrink tax liability while also benefiting worthy causes. The key is documentation and ensuring all IRS rules on charitable deductions are followed. And I hope this quick breakdown was helpful to give you an estimate of how much lottery winners pay in taxes. I explained how the top bracket is 37%, but how does that actually work? Well, our tax system is progressive, meaning higher earnings are taxed at higher rates. Only the amount above each threshold gets taxed at that new rate. So, for a $700 million jackpot, only the winnings over $539,900 get the 37% rate. The first $9,950 is taxed at 10%, then $9,951 to $40,525 is taxed at 12%, and so on through the brackets. But the vast majority falls into the top 37% bracket for total federal taxes of around $247 million. This helps make sense of how the progressive tax system works. You only pay each rate on the amount in that bracket. Next, let's go a bit deeper on state taxes. I mentioned they vary from 0% to over 11%. What determines each state's rate? Well, there are a few key factors. Some states like Florida and Texas have no state income tax at all. Others like California have progressive taxes with several brackets and high rates for top earners. States also differ on taxes for capital gains, dividends, and other investment income. So your tax bill can really depend on the state. 7 states have no income tax, but do tax interest and dividends. And some cities like New York City add their own local tax too. So make sure you understand your state and city tax rates when calculating taxes on lottery winnings or other windfalls. Where you live can make a huge difference in your total tax bill. Alright, those are some extra details on federal and state income taxes related to lottery winnings. Let's change gears now and talk about strategies to reduce taxes. What are some clever ways winners can hold on to more of their jackpot? One approach I already mentioned is taking the annuity payment option instead of a lump sum. Stretching payments out over decades helps stay in lower tax brackets each year. But this does require budgeting discipline, since you won't have all the cash up front. Another popular tactic is creating a trust to receive the winnings. Certain types of trusts are treated as independent tax entities, allowing people to use them as a tax shelter. But trusts come with costs to set up and maintain. Winners can also move to states with little or no income tax. Imagine how much lower your tax bill would be winning the jackpot while living in Florida or Texas. Even moving after winning can save you millions. Finally, as I mentioned, donating some winnings to charity can earn tax deductions and reduce your overall taxable income. That's a smart move if you plan to give some of that money away anyway. Alright, by now you should have a solid overview of how lottery jackpots get taxed. Remember, if you ever win big, make sure to get help from financial and legal experts right away to keep more of your windfall.